This company is already building critical space infrastructure that governments depend on, and yet its stock still trades, like the market hasn't fully noticed what's happening. That gap between reality and price is why Redwire deserves attention right now. And before we go any further, always check the latest price yourself, because stocks move fast and conditions change quickly. As of this recording, Redwire trades around the mid-$8 range, but that can shift at any time. Redwire isn't a hype story. It's not about space tourism, memes, or futuristic promises that may never materialize. This company designs and manufactures real systems that are already operating in orbit and in defense environments today. Docking mechanisms, deployable solar arrays, and autonomous systems aren't optional technologies, they are foundational to how modern space missions function. And that's exactly where Redwire operates. What's drawing renewed attention to this stock is execution. In late 2025, Redwire secured a major multi-million-dollar contract to provide spacecraft docking systems for a European reusable space capsule. These are not experimental parts. Docking mechanisms are mission-critical hardware that must work flawlessly in zero-gravity conditions, and only a small number of companies worldwide are qualified to deliver them. Winning a contract like this signals trust, capability, and long-term relevance in the global space ecosystem. This matters because space infrastructure spending isn't slowing down. Governments and private operators are shifting focus away from flashy demonstrations and toward systems that enable sustained operations in orbit. That includes power generation, docking, and autonomous logistics, exactly the categories where Redwire has built its portfolio. These aren't one-off sales. They create recurring demand as more platforms are launched and maintained. Financially, Redwire is still in transition, and that's important to say clearly. The company is growing revenue at a meaningful pace, crossing the $100 million mark in quarterly sales, but it is not yet consistently profitable. Free cash flow remains negative, largely because space and defense manufacturing requires upfront investment before contracts fully mature. This is not unusual for companies operating in capital-intensive sectors, but it does introduce risk, and investors should be aware of that. The reason some investors see opportunity here is the direction of travel. Margins have shown improvement, backlog has expanded, and contract wins continue to diversify across regions and applications. Redwire is no longer dependent on a single program or customer. Its revenue stream now touches civil space, commercial space, and defense-adjacent markets, which reduces concentration risk over time. Another important development has been the company's expansion into autonomous and defense systems through acquisitions. By integrating uncrewed aerial platforms into its business, Redwire widened its addressable market beyond space alone. This positions the company to benefit from rising defense budgets and increased focus on autonomous operations. These systems are not speculative. They are already being evaluated and deployed in real environments. From a market perspective, Redwire sits in an interesting position. The stock has rallied strongly at times, only to pull back as investors debate execution risk and cash flow timing. That volatility reflects uncertainty, not irrelevance. In fact, analyst coverage suggests that if Redwire can demonstrate sustained revenue growth and progress toward positive free cash flow, the valuation framework could shift materially. Consensus targets imply meaningful upside from current levels, but those targets depend on delivery, not hope. This is where discipline matters. Redwire is not a guaranteed winner, and it is not suitable for investors who need immediate results. It is a company building long-cycle infrastructure in sectors where contracts take time to convert into profits. Delays, cost overruns, or funding challenges could impact performance. That's the downside case, and it should be respected. The upside case rests on a few key factors coming together. Continued contract wins validate the technology. Margin improvement shows operational efficiency. And eventual free cash flow positivity would mark a transition from investment phase to value creation. If those elements align, the market may begin to re-rate the stock away from small-cap uncertainty and toward infrastructure relevance. If you're finding this kind of deep, data-driven breakdown useful, take a moment to subscribe. This channel focuses on understanding real businesses, not chasing hype, and that long-term mindset is how disciplined investors stay ahead. One more thing worth emphasizing is timing. Markets often price companies based on what they were, not what they are becoming. Redwire still carries the perception of a speculative space stock. even as its operations increasingly resemble a defense and infrastructure supplier. When perception lags reality, that's where opportunity can exist, but only for investors willing to follow the data and remain patient. As always, this discussion is for informational purposes only and is not financial advice. Every investor's situation is different, and you should always do your own research and consider your risk tolerance. And once again, make sure you check the latest price before making any decision, because prices move fast. Redwire is a reminder that not all under $10 stocks are the same. Some are stories built on hope. Others are businesses built on contracts, hardware, and execution. This one sits firmly in the second category, with both potential and risk clearly on the table. If you want to stay ahead of where smart capital is quietly positioning next, make sure you're subscribed. More deep dives like this are coming.